Thanks for tuning in to Profit Insights. I'm Vijit Shah, and over the next 25 minutes, we'll talk to the top think tank at Citi India about what they feel is in store for the rest of FY26. If it's possible to look that far out in such a in a world wherein weeks are as long as decades, maybe sometimes. But let me introduce the team here with me in our studio. Surendra Goyal, Head of India Research at Citi; Arvind Sharma, Head of India Autos and Transportation; Kunal Shah, Head of India Banks and Financials; and Vijit Jain, Director, India Internet at Citi. Gentlemen, all of you, thank you so much for taking the time out. And Surendra, now it's been 6 or 7 Truth Social posts and some reverts from our side as well, which are saying a trade deal is imminent. My question to you is that a sufficient condition? We know it's a necessary condition. Is it a sufficient condition for the next leg of a market rally as we are close to all-time highs, or do we need more?
Yeah, so first of all, thanks for having us on the show. So I think the trade deal, okay, the contours of that, the details, I think all of that will be important to watch out for. And what we have been writing in our notes for the last couple of months, that it is one of the key things on which clarity is required and positive, which kind of firstly, if you think about what has happened this year, right, to put this in context, India has underperformed emerging markets by 25% odd for a few reasons. The first is obviously there was a view, say 6 months back, that India will be one of the biggest beneficiaries of a trade deal with US. From there, we came to a point where our effective tariffs were on the higher side. Okay, so that is definitely for foreign institutional investors, which is where the outflows are from, a big issue. And second has been the AI trade, which has benefited other countries in EM a lot more than India. Now, one of those issues gets resolved if we get clarity and favorable clarity. And to that extent, it is going to be one of the big catalysts for the market. And the other thing which has already happened is the GST benefits, which are starting to come in. We already saw numbers being better. Festive season was much better. So in our note, we put out these 2-3 things. And to that extent, yes, clarity on the trade deal is an important overhang. And that should help the market as we go forward. And the other things are in place, right? The setup is right. There is a huge underperformance. Earnings, at least after a year plus of downgrades, we saw stability in the last couple of months.
I read your note, yes.
Yeah, this earnings season, EBITDA growth and profit growth for top 100 companies was 12%, which was better than expected. There is a big underweight among EM investors. It's close to 20-year highs, the degree of underweight. So I think the lot of the conditions are in place. And to that extent, I think as clarity emerges, it should help the market.
Got it. But so the trade deal by itself doesn't help earnings, right? I mean, largely because the sector's impacted, not a very high market cap. So is it a trigger for FI flows, and which is why it's positive for markets?
See, typically 2 things, right? One is, if you go back, markets don't like overhangs, right? They like clarity. So it will bring clarity, okay? And so that's the first thing. And secondly, yes, as I said, if you look at the underperformance, if you look at the outflow, and when we talk to foreign investors, it has been a very dominant theme in discussions. So to that extent, I think clarity, particularly if it's favorable, automatically will change the course of the discussion and narrative. And when you are sitting on so much underperformance, that should help reverse at least some of the underperformance.
Okay. And I know, Surendra, you will tell me that it depends on the contours of the deal, as it should, right? But I'm just trying to understand that if we reach a trade deal which is decent, right? We don't know what is decent, but let's assume decent is anything 25 or sub 25. If it's 15, then it's really great or whatever. But you'll see the contours. Yeah. But broadly speaking, when I read your note that came out, you are constructive than before, not overtly bullish. At least that's the tone that I sensed from your note. Yeah. If the trade deal were to happen, can the tone change in your note that the next morning?
Yeah. So, see,
will the targets change?
So if you think about what I said just now, right? Markets like clarity. So firstly, you need clarity, and then obviously if it's more favorable than what the market thinks, that's an additional positive compared to where we are today.
Got it.
So that's how I would
So your targets might change depending on the
I can't comment on that, obviously, but yes, it is an important variable which we are looking at.
Okay, okay, fine. And it will have a direct impact maybe on a lot of themes, but one of the themes, Kunal, that will benefit per se, right, of with all clarity is BFSI, because a large presence of foreign institutional investors, so from a flow perspective, and any which is with all that's happened to consumption as well, which we'll talk about, banks are indirect beneficiaries in a big way, right? What is your sense of how is the earnings picture and the sentiment picture for your sector looking currently?
So we have already seen Bank Nifty outperforming the overall Nifty by almost like 6% year to date. And today when we look at the overall setup, even for the banks, it's favorable because margins have almost bottomed out in the second quarter. Growth, there were a lot of apprehensions earlier. The street was expecting closer to like 10-11%. We were of the view that we could be closer to like 12% growth at the industry level. I think now this 11+% print, which is coming through in the fortnightly numbers, that is giving much more confidence that we can get towards 12-13% credit growth as well. And asset quality, I think that gets maybe if with the lower tariff, I think some of the concerns which were there with respect to export-oriented industries, that also, I would say, that gets led to an extent, and that could help the overall asset quality outlook. And for the first time, we have seen some kind of a stability in the earnings, and for few of the banks, we in fact even saw the earnings upgrade after a long time. It's been like last 6 odd quarters wherein we have continuously seen kind of earnings downgrade in banking sector. For the first time, we started to see the stability and earnings upgrade. So that's also the good sign for the overall banking industry. And that's where we believe maybe if growth is favorable, asset quality, there are no issues, maybe no new segments showing any stress, and maybe margins bottoming out, earnings outlook should be positive for banking system.
Very good. And therefore, what brings to the next question is that how do you play this, right? Because, much as you think of top franchises and you want to buy, I was just coincidentally just doing this check, 5-year journey of a Bajaj Finance versus an SBI. And who would have thought back then, but Bajaj Finance has underperformed SBI massively, like 1:3 or thereabouts, right? How do you play this credit growth up cycle? Do you use PSU banks? Do you use private banks? Do you use this apparent consumption boom and use NBFCs? What do you do and how do you play it?
So interesting one, and I think one of the variable which will be keenly monitored is going to be growth. Because I think now margins, looking at the deposit and the loan profile, everyone is expecting how the behavior on the margins could be. And I don't think there will be too much of deviation, maybe in terms of the actuals, which will get reported over next couple of quarters versus the expectation. Asset quality, I think everyone has been doing quite well. And wherever there was pain, be it in the personal loans, credit card, or maybe even MFI, I think that has also bottomed out. So asset quality is also favorable. So I think the key variable which is going to be looked upon is growth. And whosoever has the liability franchise, has the capital, maybe who have invested in terms of technology, distribution, and who can participate in the growth, we are seeing a lot of re-rating happening in those stocks. So as you mentioned, maybe compared to that of large caps, we are seeing more interest coming in for the mid-sized banks, because there they can deliver, there are expectations that now they can deliver more than 20-25% growth as well. As you indicated, maybe Bajaj, it has always continued to be like more than 25% average CAGR. And when you look at PSUs, it's more of a cyclical. And when you look at it maybe last quarter, everyone was looking forward to on PSUs, whether they are able to sustain 1% ROA trajectory or no, because there were expectations that the treasury gains are going to be limited. And most of the PSU banks, when you look at it, they delivered more than 1% ROA, even with limited treasury gain. And that's where we saw, be it SBI, almost maybe post the QIP, it has delivered more than 20% return. And most of the PSU banks have outperformed. If you look at it like last 3-6 months, they have outperformed by more than 10%, 15%
Exactly.
to Bank Nifty. So I think that's why the trade has been, that sustenance of the ROA was critical in case of PSU banks, and that's happening.
Okay, so I'll come to the non-lending part in a bit, but very quickly, the mid-size piece that you spoke about, what is your pecking order at Citi?
So we like RBL and AU Small Finance Bank.
Okay, those are the two, and in that order?
In that order.
Perfect. Okay, thanks so much for that. Vijit, welcome to the show, and thank you so much for coming here to our studios as well. Looking forward to this conversation because it's a hot space, right? And the one thing that you might not be able to defend his valuations because it's always easy to take pot shots at those valuations. Right? How do you look at the space currently, especially after the last couple of quarters and the small changes that have happened to the numbers?
Yeah, sure. So, the internet space, the platform companies, it's always been a story about competition coming in waves, and companies choosing growth over, say, margins and higher EBITDA in the near term. And I think in the last, we've seen a whole episode of this through the course of this year. Initially, in the middle of this year, you thought that companies are prioritizing margins over growth, and so you saw earnings upgrades across most of the companies that we cover. And more recently, I think we are back to a phase where companies are choosing to go for growth. So you see that across quick commerce, you see that in food delivery, you see that in e-commerce as well. I think a combination of customer acquisition costs coming down to a point where companies want to go for growth, go for market share is in vogue right now. I think for our companies, the way we look at it is, if over time your marketing efficiencies are great, if your growth investments are actually yielding new customers, good quality customers, then these companies are investing rightly for future growth. And we prefer to back those kinds of companies. We like those kinds of companies.
And just trying to understand, because it becomes difficult for an average viewer to understand this, right? When you look at all of these metrics, where is it that you find a confluence of some of the elements that you spoke about within that universe? And also, is just part two of my question, would large imminent fundraisers in any of those businesses and large equity dilutions be a point of concern, or do you digest that because of the nature of the business?
Yeah, I think it depends, right? So, see, fundraisers obviously raise concerns, especially if companies are raising funds to kind of compete with each other. And if you think about it as a zero-sum game, where my gains are going to come from at your cost directly, then it's obviously concern. Then it means that you're just burning cash while not expanding the pie. But in categories like quick commerce, for example, you could argue that decent chunk of the fundraisers will also help these companies kind of grow a little bit better. Expand the universe and ambit of quick commerce, for example, a bit more. And so it's a trade-off. It depends on execution, whole bunch of other things. But yeah, as long as you're deploying that capital effectively, I think you can look at it more constructively, which is to say that a number of other things also matter. But it's always been the case with internet companies that adequate amount of funds in your balance sheet is an important factor, because it gives you the confidence to deploy capital over a period of time rather than worry about if the market turns and capital raising becomes difficult in the future, that you're caught in a hard space.
Okay, so Vijit, just last follow-up. I mean, you might have coverage on some, you might not have coverage on some, but within that universe, and it could be the consumption tech or otherwise, where is it that you find favor and why? What names do you like on your list?
So, we do like the consumption tech. We do think that within that, the quick commerce space especially, we like the OTA space. E-commerce has been a bit of a mixed bag for the kind of companies we cover. Essentially, you would like to see better growth there for some companies. And yeah, so those are the two top preferences for us.
So both Eternal and Swiggy fit in that list. I'm just trying to understand, how does it work?
Yeah, so Eternal is our top
is your
pick.
idea. Okay,
Make
fine.
My Trip has been a top pick. And then, we do have fintech coverage as well, a little bit of that. It's showing signs of improving profitability.
Got it.
Hopefully it gets there as well in terms of, coming up in terms of the pecking order for investors as well.
Okay,
Yeah.
fine. And just before I come to a sector that I really want to know a lot about, because everybody is dissecting what's happening in October and November, but there's a tail in out here to the internet point, which I want Surendra, you to come in. Traditionally, all tech in India was classified under one roof, whether it's IT services or tech or whatever. Now there is a clear differentiation. If I were to ask you, as somebody who looks at the research piece as a whole, but also looks at IT closely, right? Do you have a view on consumer tech versus IT services per se? Because I know you're largely been not so constructive Indian IT services businesses?
Yeah. So of course, just to qualify, obviously it depends on a lot of factors at any given point of time. Valuations, the starting point of valuations is an important part of that framework. But if you look at, say, as of today, we do have a consumer tech name in my top picks, but I don't have a IT services name in my top picks. So that will tell you, and we have had a underweight on IT services for a long time. Okay, so I think you need to be in growth. India, obviously, the market focus is always on growth. But as long as you are in growth at okay valuation, and valuations are generally high in consumer internet, but okay valuation, and particularly if a company is really strong and you believe it's a medium-term winner, I think you can still kind of continue to hold it. So we like consumer tech. IT services, my concern has been around the trajectory of growth. So we have generally been underweight. So as of now, I don't have a single top pick from IT services.
Yeah, it's almost become easy for me because whenever there is some bit of an exuberance in IT, I wait for Surendra's notes because that note comes and it's like, change kya hua hai bhai? So last time tha abhi bhi wahi hai, and yet people are getting exuberant. So it's been very interesting that way. Okay, autos. I want to start off with that because almost, I was looking at the trend commentary, for example, and it seemed to suggest that they are saying that people have gone in for the higher ticket items purchased first, and trends seem to believe that people will then come in for the low ticket items, the staples, etc. Did you sense from the quarterly numbers, from the commentary that came in, that things are gonna look hunky-dory for Indian autos, two-wheelers, four-wheelers, tractors, etc., because of this GST cut? And will Q3 be a remarkably good quarter? I'm trying to understand. And will it set the stage for further quarters?
Sure. So if you go back before the GST cuts, also the change in the tax slabs, generally better rate environment, and then the GST came in on 15th of August. So naturally, things were setting right. All stars were aligning for a good growth. Between 15th August and 21st September, we weren't buying because we didn't things are getting cheaper. On 22nd September onwards, things really came up, and if you look at those 42-day period, we're up almost mid 20% across all sectors, across all subsectors: passenger vehicles, two-wheelers, tractors, etc. Since you're talking about the quarterly numbers, companies were still a bit cautious. That's why you see most of them talked about second half growth of mid to high single digit. None of them was extremely exuberant saying we're going to go up 10, 12%. No. But what we've seen now that we are towards the end of, almost end of November, things are holding on. The retail data does show a fairly steady number in both entry-level bikes, entry-level cars, as well as even some of the premium bikes and cars as well. So it seems to be across the spectrum that we are seeing good growth. Now, what remains to be seen is November the month when everything subsides, or do we go on further? Our sense is some of these changes are more structural. Thanks to GST, prices have been cut. When you look at the price cuts, actually companies have gone over and beyond what GST mandated. Beyond that 8.5%, 10%, we've seen companies cutting prices by 18, 20% on specific models, right? So if that goes on for some time, and thankfully rural India is doing good, we see that in numbers, in tractor numbers, which is very visible. So we believe that there should be an uptick in broader demand across segments. Naturally, small cars or small or entry-level bikes, which have been weak for so long. Last time small cars were doing good was probably 3, 4 years, 5 years back. So you have a base that helps them, right? But even accounting for that, on a broader passenger vehicles and two-wheeler space, we should see a decent growth in second half. Tractor is something which has surprised us literally every month. You see commentaries getting more positive almost on a monthly basis. So there also, I think we should see a good second half.
Okay. Can I just tie this in? I mean, vehicle financiers, is their commentary looking that constructive as well?
So in terms of outlook for the second half, everyone has been quite positive, be it with respect to growth as well as the credit cost coming off. So on the growth side, in terms of the targets, everyone is saying like by second half it should improve compared to what we saw in the first half.
Okay, so that is great. Okay, now if I can dissect and peel that layer just a bit, I heard you, I mean, you gave your hand when you said that tractors have surprised positively. Conversations with M&M and others as escorts, etc., also point towards that. What what's the valuation versus growth parameter telling you about entry points for any of these autos? Because we saw that pattern that a lot of pre-buying happened in the stocks in anticipation of a very good thing, and then the stocks have cooled off a little bit. The last 1 month, I don't think there's been too much of a rara move into any of the auto names. So is this an opportunity into any of the auto segments to log in? And what? I mean, is it passenger vehicles? Is it premium bikes? Is it entry-level cars? What do you like?
True. I think just when the GST sort of was unraveling itself, there was a big uptick across all auto names, and things have not been as exuberant as they were in the first half of the period.
Exactly.
But partly it's also because the commentary, as I said, was a bit cautious. I think what investors would look now is does the volume sustain? If you look at carefully of what the managements were saying, they were obviously cautious, but they said we have to wait for November to ensure there's a trend that goes on rather than a mere blip. I think so this where we are right now, as I said, the fundamentals look good in terms of volumes where we are. So we still like the passenger vehicle names more. Our topics are passenger vehicle names.
Both M&M, Maruti.
Both Maruti is a topic and followed by M&M. We also find that some of the bike makers now are doing quite well versus what was expected earlier. That's how we would position ourselves.
Okay, yeah, I think Hero saw some upgrades recently, and I believe you guys also maybe wrote on it, right?
So we were positive on Hero going into GST as well, because they benefit the most relatively from a push in the entry-level bike segment, and they have been doing their job in terms of going into EVs and scooters and premium bikes.
Got it. Okay. Yeah. Okay, great. Now, so that is great to also know. Surendra, what about the sectors which we haven't covered thus far? And when one scans the numbers, I think one or two obvious winners, aside of the ones that we've spoken about, cement, for example, blockbuster first half, if you will, at least in terms of reported numbers. Is there merit in trying to think about that sector? What else stood out for you guys as a house after quarter 2 for the next 2 quarters, next 4 quarters?
Sure. So firstly, answering the question on cement. Cement is a sector we have been overweight since the start of this year.
Okay.
Okay, and the rationale even then was that last year obviously was quite muted because there was a prolonged period where capex was weak and so on. And the entry point valuations again were pretty decent. Now what we have seen that play out is things kind of normalizing, numbers starting to improve, and that is what we continue to like. Of course, we are selective. We like a few names, but we continue to like the cement space. It's still an overweight in our sectoral allocation. Other than that, telecom is something which we have continued to like. It's been a consistent overweight for us. So that's, again, the numbers are strong, right? The drivers are all there. Okay, and to that extent, we still expect very strong EBITDA compounding to continue in telecom. Similarly, hospitals is a space we like. Again, good EBITDA compounding just continues. Again, these sectors may sound a little boring because they have been doing well for a while, but I think the EBITDA compounding is what continues to look quite attractive to us. So I would say those are the spaces. The industrials part, we have a more neutral kind of a view as far as sector allocation, and again, very specific picks looking at the portfolio, who is more indexed to data centers, for example, right? Some themes we are trying to play, but overall in those segments we are more neutral.
Yeah, a slightly boring question to end this conversation, but the typical debate that comes up, well, the most common meme floating around is of this guy or the lady who's throwing the kid up in the air in the pool, and that's the Nifty, and the other kid is drowning, and that's the portfolio of people, because large caps have done very well, mid caps, small caps haven't quite done well. Do you reckon that if indeed this trade deal were to happen, FPI flows, etc., were to come in, that will favor the large cap space a lot more versus the mid caps and the small caps?
See, the way, and again, I've been saying this for many quarters now, that we have tried to be more market cap agnostic. We have been saying that it's more stock specific rather than trying to say, okay, large cap will do
change in 2026?
It can change, but if the market becomes very euphoric, right? People become very positive. But in my view, that really needs to, typically it is accompanied by a lot of earnings upgrades. Okay, so if that comes through, then you could get to that scenario where people are indiscriminate in what they are buying, and you could have that kind of a rally. Right now, the good thing has been that it's been a tough market, and which is why people have started being a bit more disciplined in terms of looking at a lot of metrics and thinking about it before, and I'm talking of the retail investor behavior. You can see that in stocks and sectors. So if it gets euphoric, then obviously things can change. We have come out of that. There was a period where you saw everything do well, right? Irrespective of earnings, irrespective of outlook. So that is what is required in my view for that change to happen.
Well, great. Gentlemen, thank you so much, all of you, for joining in today. Lovely talking to you as always. Vijit, great talking to you the first time. Didn't feel like that, but look forward to talking to you more.
Thank you.
And viewers, thanks for tuning in to this very special conversation of Profit Insights with the top think tank at Citi.